And yes, the gold bull market is finally breaking out after being in a trading range since 2011. Silver's not quite there yet, but as we know, silver will catch up to gold in the end phases of the gold bull market, and it will catch up with a vengeance. Bank reserves are approaching the crisis line of about $3 trillion that triggered the last banking crisis, and it will trigger the next one as well.
Gold's bull market is finally breaking out after years in a trading range, while silver is expected to follow soon. Rafi Farber explains how collapsing bank reserves, high interest rates, and silver prices. Stay informed as we navigate these financial shifts together.
The metals have calmed down this week, but there's a lot going on in the banking system that we actually haven't seen since September 2001. And it's extremely deflationary, which means that there's something coming down the pipe very soon. I'll show you the reserve numbers in a second. Remember the basis trade? It's back, baby. There's all-time record shorts by the hedge funds in 2-year treasuries. The gold bull market is finally breaking out, about to break the 200-week moving average. You got to be careful not to confuse a gold bull market with a commodity bull market. And yes, the gold bull market is finally breaking out after being in a trading range since 2011. Silver's not quite there yet, but as we know, silver will catch up to gold in the end phases of the gold bull market, and it will catch up with a vengeance. Bank reserves are approaching the crisis line of about $3 trillion that triggered the last banking crisis, and it will trigger the next one as well. High interest rates are being locked in because the government is being forced to sell longer term notes and roll over the bills to the notes category. I'll show you the statistics on that one. And the Bank of Japan spent about $50 billion supporting the yen 3 times this past week. We'll see how long the intervention succeeds. The last time it took about 3 months. This time I think it'll be shorter. The yen is doomed, but the Bank of Japan can buy it a lifeline of about a few weeks, maybe a few months, but that's really it. I showed this chart 2 weeks ago. Something is happening here. This is gold relative to other commodities. It's important not to confuse a commodity bull market with a gold bull market. There's a reason that we are gold and silver stackers as opposed to, let's say, oil or natural gas stackers, though there could be natural gas stackers. I don't think that's particularly healthy. What we see here is the gold to commodities ratio, and basically it's been in a trading range since 2011, since the 2011 top here. And we see here that the bull market really began in 2008. This was the beginning of the destabilization of the financial system. It was stable over here, the gold to commodities ratio, pretty much until 2006. And then it started to move up, and then in 2008 it really moved up. But since 2011, it's been in a trading range. And also, since 2021, we've been below the 200-week moving average, but that is now finally changing, which is suggesting that we are on a major bull run of gold relative to other commodities. And this ratio is really, it's a proxy for the profit margins of gold and silver miners. So the higher this ratio goes, the more profitable miners are. If we zoom in here, we can see that we are right on the cusp of breaking the 200-week moving average for the first time since 2021. This is a very rare event in gold markets. The 200-week moving average is at 8.11 here, the red line we see, and we are at 8.10. We're just about to break it. Let's see how rare this is. Well, this has happened about 3 times since 2008, when the gold to commodities bull market really started. So it happened once in 2014, at the end of 2014, and that looked like a gold bear market, but it was really a bull market relative to other commodities. It was a commodity bear market, but gold was falling much less. And here it happened again in 2019, though we had barely gone below the 200 moving average here. So if you want to count this, fine. If you don't want to count it, you don't have to. Technicals like this is more of an art than a science. And here we have, for the 3rd time since 2008, we're breaking through the 200-week moving average. And once we break through that, I do believe we will be on a sustained bull market. You could call this a bull market, but what it really was the shutting down of the global economy for the best reasons ever in the world that nobody may ever dispute. But if we iron that out as just a little blip of insanity, we're about to embark on a gold bull market relative to commodities, and silver will, of course, follow. If we zoom in on silver, see what's happening here, silver relative to other commodities, we are at resistance here in the silver to commodities ratio of about 0.09.1. We're just below the 200-week moving average, so we're going to break through it. It's just going to take a little bit more time, and once we do, we should be in a silver bull market also relative to gold. And in that final year of the gold bull market, as we saw in the late 1970s to 1980, silver should break out. It should be quick, it should be brutal, and it should be glorious.
Rafi Farber predicts a gold bull market breakout and an eventual silver surge. He warns that bank reserves nearing $3 trillion could trigger another crisis. Rising interest rates and Bank of Japan interventions signal economic instability. Farber highlights a profitable future for miners and a sustained gold bull market, forecasting a deflationary wave and significant money printing by the Federal Reserve, boosting gold and silver prices. He urges viewers to stay informed.
Now, I wanted to go into the banking situation here. This is banking reserves. Bank reserves are reserves that banks hold at the Fed. So this is really the liquidity line, how much extra liquidity banks need. Now, the higher the pyramid goes, the more liquidity that there is in the system, the more liquidity that is needed, because banks obviously make loans and therefore they need reserves to cushion against those loans, and they themselves go into debt. So the more reserves there are, the more reserves are needed, which is why I drew these two lines in. You see here, this is right before QE3 in 2012, and then QE3 brought us up to a new level of reserves just below 3 trillion. And then once we fell back to the pre-QE level of reserves, we hit a repo crisis, and that was in September 2019. So we see the same thing here. We hit a new level of reserves because of the crisis over here, which we don't want to talk about. And then we hit a high over here just as 2022 came into being. New Year's 2022, we hit a high. And then QT starts again. The Fed starts shrinking its balance sheet. We head down to about $3 trillion, the previous line of where the new QE line stopped initially. And then we hit another banking crisis. This is around March 2023 over here. And so we're heading down again. We're going to zoom in a second. I'll show you how far we are from this new banking crisis line, which I assume is about $3 trillion. It's not going to be exactly then, and it's not going to hit exactly when we hit the line. We see here in the banking crisis of 2023, it took a few months for this line to be approached, for the banking crisis to be triggered. But it is around $3 trillion, and it will happen somewhere around there. If we zoom in, we can see here we are at $3.25 trillion. This number over here is about 3.585, if I remember correctly. So we're down about $330 billion in the last 3 weeks. We could hit the crisis line anytime, and there's no reason that we shouldn't, because we're still in QE, and even though the Fed announced that it is slowing down QE, it is continuing, QT. They are slowing down QT, but they are continuing it, and the slowdown will only happen in June. So we have another 4 weeks to fall another $252 billion to reach the $3 trillion crisis line. And then it should take a few weeks, maybe a few months, for the next crisis to be triggered somewhere in the repo market, somewhere in the banking system. I don't know exactly where it's going to hit. So the conclusion here, my friends, is that we are headed into another deflationary wave, not consumer prices. I'm not talking about consumer prices. Those will continue to rise. You can have consumer inflationary epics together with actually financially or monetarily deflationary time periods. They can coexist, and that is where stagflation comes from: rising consumer prices, falling asset prices. If reserves are falling and deposits are falling, that is where we are headed. And once we are headed there, and it's undeniable, the Fed will, of course, reflate, print again, and that should take us to the end game within months. Who knows how many months, but it shouldn't be that long, because the next printing round is going to be quite extreme, triggered by whatever crisis comes next. And just as we're seeing gold starting to break out relative to commodities, once we do have that final printing round, we will have gold and silver climbing relative to other commodities, not because of any lockdowns, but because of monetary panic.
Thank you for joining us on this enlightening journey through the complexities of our economic landscape. If you found this exploration valuable, don't forget to like, share, and subscribe for more insightful content from Rafi Farber. Remember, Staying informed is the key to navigating the ever-changing currents of our financial world. Until next time, stay curious, stay informed, and stay ahead of the curve.